how his internet is holding up. Welcome, everybody. It's a second time this year that we're having this Center for Political Economy series on money and finance with the focus on liquidity and uncertainty. In other words, we are seeking to revive and discuss the spirit of Keynes. And we're going to continue with our discussion of Keynesian thought by focusing on investment and the investment function and how to think about investment under conditions of radical uncertainty in capitalism. To do so, we have today with us two outstanding scholars on the topic. And so we're really, really pleased and thrilled to have both Jonathan Levy from Sciences Po and Martijn Konings from Sydney joining us, which is also a real exercise in globalization, dear Americans. Here we go. And what we are going to hear is both, I hope, theoretical and empirical work from Jonathan, who has just published two books, one on ages of American capitalism, an empirical study, and both also a theoretical construct, a theoretical book that he called The Real Economy, which I think both of them have to be read together, at least that's how Jonathan presents them. And then secondly, we have Martijn, who is a great scholar of American capitalism, maybe a bit more focused on the 20th century, and who's just recently published amazing books on capital and time, on the growth of American finance, and most lately, the bailout state. So thank you very much to the both of you for making the time and for being here with us today. And Jonathan, I hope Catherine has made you co-host. So if you want to share slides, you can. But if you want to read like a real historian, please feel free to.
Okay, so the floor is mine. Excellent. Yeah, no, I don't have any slides. Good evening, good afternoon, good morning. It's a pleasure to be here, be part of this conversation. In particular, to be here with Martin, who we've never actually met, but who's one of my favorite scholars, who I've learned from, deeply. So it's terrific to have a chance to interact this way. I'm going to speak about. I'm going to talk about liquidity. Maybe it's the end of the term here, a little bit late at night. I've been kind of a confessatory mood, but I've written, as Matthias indicated, a lot of history trying to use liquidity and liquidity preference as analytical categories. So a lot of pages, but I still often find myself very confused when it's time to talk about liquidity. And I don't think we're quite clear on the concept yet. I think Keynes he was confused too. I'm going to talk about what I think were some of his confusions. I think Keynes, as he often did, used his gift for rhetorical flair to kind of paper over and cover over a lot of his confusions. It's one of his sort of constant tics. I sent some readings from a book that I love that I think is not read enough by John Hicks. It's called A Market Theory of Money. Hicks, I think the advantage of Hicks in the kind of classic English style is that Hicks is extraordinarily clear, by contrast to Keynes. Maybe Hicks is too clear, actually. He makes things sound a little bit too easy sometimes, but I think it can be a helpful contrast to Keynes. Liquidity, as Hicks says, I'm not aware, some of the people on this chat, this room might be aware. I'm not aware. I think Hicks is right that Keynes was the first political economist, to employ liquidity as a category of analysis, as an analytical construct. And the first chapter of the book from Hicks, he recounts the reasons why that is. That neoclassical economics, as it emerged in the late 19th and early 20th century, didn't need a concept of liquidity because it assumed that everything was a flow, that in a period of time, of commodities would be traded. Money in this sense could be a bartering device. But as Hicks very clearly explained, the whole edifice crumbles when dealers, he calls them dealers, or merchants can carry stock from one period to the next. So here, without any reference to money whatsoever, I think this is important. Hicks distinguishes between a famous corn market and a fish market, markets in perishable goods or non-perishable goods. And so Hicks's point here is that there's a big difference in dealing with an economics of flows versus an economics of stocks that can be carried over periods of time. And he really sees Keynes as sort of entering there as a monetary theorist and frames kind of outbreak of debates in the 1930s over liquidity in that context, in the insufficiency that Keynes saw or recognized in Marshall and Marshall's generation with respect to this issue. As we all know, I'm sure many of you know, Keynes was a speculator himself, and so he pulled the term liquidity out of kind of ordinary financial discourse. It had been there since the 19th century to refer to converting assets into cash. That was the kind of colloquial use of the term. It had sort of deeper roots. Liquidity has a French root, it has a Latin root. Keynes read a lot of kind of early French economic thinkers, Montesquieu, Cantillon, and you can sort of see the origins of the liquidity concept there. Keynes says that in the French preface to the general theory. But then liquidity kind of drops out. I mean, it's in some post-war discussions. Hicks certainly kept running the flag. He kept discussing liquidity. But for the most part, kind of post-war neoclassical economics, liquidity isn't much of a category of analysis or a subject of debate. And then, of course, with 2008, it comes sort of raging back, where all of a sudden liquidity becomes an important topic, if not a category of analysis. I think there's sort of three ways liquidity tends to be discussed in the post-2008 literature. First, liquidity, well, I think four actually. First, liquidity often just means money. People are for liquidity, they just mean money. Second, they mean converting an asset into cash, which is, I think, the original colloquial financial usage. That's a second kind of meaning of the term. Um, Third, it's to convert one asset into another asset without losing the value of that first asset. It's often referred to that way. And then fourth, I think in the kind of Minsky tradition, although I'll leave that to Martin, liquidity can mean access to a means of payment or someone accepting your collateral, being able to maintain yourself as a going concern. To stay liquid in this sense oftentimes means to be able to stay solvent. But I think that there's a kind of another tradition, and I think all these ways of define liquidity are appropriate and good, and I'm certainly not objecting to them. But there is another tradition, I think, for defining liquidity and thinking about liquidity that goes back to Keynes, that I think Hicks is particularly preoccupied with, that is in tension with those ways of understanding liquidity. And I think is a kind of a tension that we have a hard time kind of thinking through. And that is liquidity as a reserve asset or a store of value. As Hicks says, any good, he says, any durable good that's non-perishable can be a store of value. So here, liquidity does not refer to money. Money can perform this function, but it's a completely different concept than money as such. So Hicks says, I'll read from my Hicks, I have it open to page 62. We ought to say that liquidity is a characteristic of an asset that is held as a reserve. A characteristic of an asset that is held as a reserve. He goes on to say that in his view, Keynes had a better understanding of liquidity in the treatise on money as opposed to the general theory. Because in the treatise on money, Keynes defined liquidity as a relative quality of assets, and that different assets could serve as reserves and be a store of value. I think that's right. Although I'm still, I mean, I think that's like an interesting point, and he has, from that basis, he mounts a critique of the general theory, which we could discuss if anybody likes. With that said, I'm still quite drawn not to how Keynes, and this is where the my own confusion kind of starts, not so much to how Keynes defined or talked about liquidity in the general theory, but I am drawn to how he talked about liquidity preference, although with some modifications. So let me say a few words about that. Um, in the general theory, Keynes talks about three forms of liquidity preference: transactional, precautionary, and speculative. The transactional liquidity preference is that kind of ability to convert assets into cash. And therefore, transactional liquidity preference does sort of locate or reside in the institution of money, even though it's not money itself. The second and the third are precautionary and speculative, but I actually think they're the same. I actually think they're the same thing, because both precautionary and speculative refer to the store of value function that money does obtain in a modern capitalist economy. There's lots of different ways to hoard. You could think of hoard as just putting money under the mattress. And this is where I think the piece I circulated, kind of reading the general theory through Freud, is the most helpful. Because I think Keynes does think that speculative liquidity preference, um, in order to do that, I mean, when Keynes talks about speculative liquidity preference, it's not chapter 12 Keynes. He's not talking about the stock market. He's talking about a motivation to hold long-term bonds, which are liquid because they store value and they're readily transactable. And the reason why he thinks people hold long-term bonds are not the best investment per se, but because they're liquid, they create the potential to always carry out the next speculative strike. Um, and so, but oftentimes people don't do that. Um, or if they do speculate, they convert into cash and they speculate again. So Keynes really thinks speculative liquidity preference undermines investments in precisely the same way that precautionary liquidity preference undermines investment. So I think his language here is a little bit confusing, and really this takes us back to kind of Hicks's distinction. He has two forms of liquidity preference, and I think he has two forms of liquidity. He has converting into cash, the transactional, and then he has this precautionary hoarding complex, which actually sort of fit together in all kinds of ways that are maybe difficult to understand at a surface level. And so where does this lead me? I mean, I guess, yeah, I am a historian, so I'm kind of become increasingly interested in trying to tackle these questions, not so much conceptually, but historically, and to try to figure out, like, when did money um, become um, the chief store of value in the economy? I think it's an interesting question. There's some hints in the general theory. Cade says it's kind of an odd statement if you equate liquidity with money, that before the Industrial Revolution, before capitalism, liquidity attached to land. Because in a feudal economy, in a pre-capitalist economy, the chief means of storing wealth was through land ownership. He has some interesting comments about how mortgage markets developed in land sales, and that kind of conjoined the two functions, the transactional and the store of value. But I actually think historically, the first store of value, we have to go back a long time to ancient civilizations, were granaries, and that commodities essentially were stores of value, which completely aligns with Hicks's understanding of the need to think about liquidity first and foremost in the context of non-perishable goods that could store value across periods of time. And I think there's a kind of interesting and to a large degree untold history of how the store of value function um, increasingly attaches itself to money as an institution. That's history of public debt. Its history very much concerns the Bank of England. the kind of birth of new financial devices in the context of the origins of capitalism, and the institutionalization of new reserve assets that are money itself, but also money like. Um, and so, in this respect, I think this history of liquidity, or this way of thinking about liquidity, points to trying to understand historically, but also theoretically, like what does it mean to be money like, or as good as money? Another colloquial term in finance, but one that I think to me is quite intriguing. So I think there is a history of how, and I think we are talking about capitalism here, conjoining these two very different functions uh, that both are the kind of two sides of liquidity, the transactional and the reserve asset kind of store of value function. And I think, oh, good. I need to stop soon, and I will. Um, that here I'm less safe, well, even less safe sort of footing in terms of thinking about the implications for, contemporary political economy. And it's at this point that I, very much would like to hand it off to, to Martin. But I do think that, thinking about the political economy of liquidity, and we often think about whose collateral is accepted, who gets access to money, who gets access to credit. But it's an equally interesting question to think of in terms of how a particular kind of political economy of liquidity works versus other institutional um, possibilities that have existed or we could imagine existing, of how the reserve function is met and what kind of reserves built up in a system, uh, depending upon the different kinds of liquidity provision that are offered. And so it strikes me that, one way, to think about the bailout state, one way to think about central banks publicly providing liquidity, backstopping asset prices, is what you're really doing is you're incentivizing a speculative liquidity preference, because you basically are guaranteeing precautionary. No one has to accumulate reserves for a precautionary reason, because at the end of the day the state will back you up, and so that reserve function and that kind of carrying stocks from one day to the next, 1 minute to the next, nowadays 1 second to the next. What you're doing essentially is you're incentivizing the building up of speculative assets, and you're catering to speculative liquidity preference because you're publicly providing a backstop in precautionary terms. And I think that kind of analysis, I think, is fully aligned with a Minsky or Minskyite approach to of thinking about an asset-based economy and how it aligns with a publicly provided backstop. So I might have spoke for an extra few minutes, sorry, but I'll stop there, and I look forward to our discussion. Thank you.
Thank you very much, Jonathan. Very provocative and very interesting to think in this way about liquidity, particularly related to reserve assets. I'll give the floor now to Martin, and then just for those of you who just joined, as always, you can put your questions in the chat, or you can just raise your hand with the function to ask a question, and I'll call on you. Okay, Martin or Martijn?
Thanks, Matthias. Thanks to Matthias and Katrina for inviting me to the seminar. So very interesting comments so far. My comments come from a different angle, but I think there's a lot of intersection between them. I hope everyone can hear me. Let me know if there are any issues, and I'll try to sort of rejig the internet a little bit. I will focus my comments on making a specific claim and then putting that in the service of a specific argument. The claim is that the more abstract and fictitious wealth becomes, the more real and material liquidity becomes. And the argument is that if you don't get that relationship in somewhat proper focus, you're very likely to end up with a problematic characterization of the present. And the main one I have in mind here is the notion of secular stagnation and the many variations on it. It's, of course, most prominently associated with Larry Summers' revival of Alvin Hansen's theory. But the core idea is very widespread, including among many more critical spirits on the left. The idea of stagnation mystifies a process that is comprehensible in terms of balance sheet interactions. And this is what Minsky referred to as the Wall Street paradigm. He contrasted that with the world of economic theory, which is modeled on what he called the village fair, where people show up to exchange their surplus commodities, and they solve the coordination problem of barter by agreeing on a monetary standard. Now, what's missing in that model is investment, and the way it creates a level of dynamic interdependence that does not lend itself to neat one-off solutions. Investing requires taking on shorter-term commitments that need to be maintained with liquidity. Now, ideally, the investment itself generates the liquidity that you need, but that may not always be the case. And in that case, investors have to rely on something else, returns from other investments, wage earnings, leniency from the bank, political favors, quantitative easing, what have you. Part of the intellectual problem we have in conceptualizing this dynamic properly is that as moderns, in Latour's sense, we tend to dramatize the break between tradition and modernity, or more specifically, feudalism and capitalism. So we tend to see pre-capitalist, directly political property relations as being displaced by the depoliticized logic of commodity production and commodity exchange. And then we tend to see capital as a form of wealth that emerges out of that commodity logic, and therefore as a more rational social form than inherited feudal wealth. That image of a clean transition from a political to an economic world doesn't really capture what happens when property becomes integrated into a monetary economy. When property acquires a capacity for abstract representation, it's no longer a thing in its own right, but it starts to reorganize the social field as a whole. It becomes virtual. It becomes the center of a gravitational force field. And that logic does contrast with pre-capitalist societies, where the everyday economy could often be relatively unaffected by routine elite conflict. Now, of course, to some extent, property has always been an abstraction. It was never just about the pure materiality of land. It's always an legal or ideological construction. But what capitalism changes is that the religious and political anxiety around the mixing of property and money reduces. And that anxiety is replaced with the village fair fantasy of economic rationality. Now, some schools of Marxism understand this quite well. Simon Clark in particular, I would cite here, Negri, of course. But Marxism as a whole, I think, has continued to be wrong-footed by the fact that capital volume one starts with the commodity. Keynes, therefore, provides a more direct way into the issue. He saw very clearly that the reason capitalism doesn't work as advertised has to do with the abstract forms that property can assume in a monetary society. And the emblematic expression of that is the rentier. Only in a financialized society does rentierism become a structural possibility. They get to live of nothing but legal title. They don't have to make appearances at court, go to war, manage an estate, run a factory, nothing. Their wealth is entirely abstract and virtual. But then in conceptualizing this, Keynes got caught in a certain ambiguity, I think. On the one hand, he realized that the rentier was a product of financialized property. On the other hand, he looked at the rentier as a relic of the past, who would just disappear with the renovation of capitalism that he imagined, and that in some way also unfolded. Of course, it just didn't eliminate the rentier. And that ambiguity has a lot to do with Keynes's treatment of money. So in the treatise on money, Keynes was very interested in the dynamics of the financial system and its legal underpinnings. Whereas in the general theory, it kind of brackets all that and settles for a more orthodox or chartal understanding of money. And that allows him to go straight to the problem of underemployment and advocate the most direct solution, government spending. So Keynes' focus shifted from the logic of finance to how abstract wealth upset the laws of demand and supply. So it's a bit of a shift towards a more mechanical way of thinking about the economy that would later prove to allow for the reintegration of his work with orthodox thinking. So in the general theory, the capitalist circuit is increasingly seen to suffer from a leak, and that causes the deflation that rentiers love. And that leak can be plugged with government spending to drive demand and growth, and that would eventually euthanize the rentier. And I think that this notion of a deflationary bias, an endogenous trend towards stagnation, is at the heart of Keynesianism. That's not just the fully mainstreamed neo or new Keynesianisms, but also more heterodox forms of post or institutional Keynesianism. It's central, for example, to Piketty's idea that R will always be greater than G in a pure capitalist system. Now, for Minsky, stagnationism was completely the weakest link in the Keynesian edifice. So to his mind, it was just bad metaphysics, distracting from an analysis of how economic units interact and get entangled in the web of claims and commitments. And you can only really appreciate the truth of that take if you break with orthodox and chartal ideas about money in a more rigorous way than Keynes did. So a stable financial structure is not created by fiat or designation. It only emerges through the protection of the balance sheets of key debt issuers. And that kind of backstopping has inflationary effects. It exempts a specific group of investors or class of assets from market downturns. And that inflationary pressure over time becomes part of the system's baseline settings. What that means is that deflationism is not a generic property of laissez-faire capitalism, but it's a policy to compensate for the inflationary pressures produced by other policy settings. It's a way to manage the contradictions produced by an institutional framework that guarantees the financial return on property. Now, that's essentially a variation of Schumpeter's idea of forced saving. Being able to create liquidity removes the need to save up before investing. But if you don't enforce some savings at some point, somewhere in the system, the danger of inflation eroding your gains is entirely real. So I think since the pandemic, people like Mark Blythe have started to make the argument that there really is no such thing as inflation as a kind of a system level phenomenon anymore. There are narratives about inflation, but those are just part of a very sort of event-driven supply side politics or supply chain geopolitics, perhaps. And I don't think this is quite the right move. I think our understanding of it, inflation is, of course, tied to specific purposes and frames that are becoming less relevant. But what we need to understand is what in my recent book on the bailout state, I've referred to as this dialectic of bailout and austerity. On the one hand, liquidity provision that allows some balance sheets to expand and to bend the economy's gravitational field around their needs. On the other hand, measures to counteract the danger of generalized devaluation by withholding liquidity from other parts of the population and essentially trapping them in a constant fight for short-term survival. And this means that a certain kind of politically constructed, we might say artificial scarcity becomes baked into the routine infrastructural operation of the system. That becomes a major obstacle to the practical operation of Keynesianism. So during the 1950s and the 1960s, neo-Keynesians find that fiscal demand stimulus does not correct for a deflationary bias, but adds to existing inflationary pressure. They try to undercut that problem with various supply-side policies meant to resolve artificial scarcity pressures. But those schemes have always primarily served to socialize the cost of investment, and they have never done much to deliver any public control over investment or pricing decisions. And so over time, this results in progressives, Democrats, Keynesians managing a system of economic policy that subsidizes business and wealthy households, which is what I call the bailout state. So quickly fast forward to the 90s. That supply side program suddenly appeared successful during the Clinton administration. But the way it worked in reality was that after the Volcker reset of the 80s, Alan Greenspan was willing to underwrite a tide of capital gains that could uphold certain kinds of middle class politics. When the Obama administration tried to do the same at a much larger scale after the global financial crisis, it produced tons of millionaires and billionaires, but there was no generalized wealth effect to be discerned anymore. And so you can call that secular stagnation, but it's fundamentally about the way the monetary, fiscal, legal, and regulatory operations of the government serve not to plug a demand gap, but to subsidize private wealth accumulation. Now, the Biden administration recognized the stagnation problem, which drove an attempt to revive a supply-side Keynesianism. But that felt a little half-hearted, I suppose. And in any case, it was just really not commensurate with the extent to which the American economy had become dominated by asset wealth. What was needed was not a doubling down on a politics of artificial scarcity, but a new politics of liquidity. And that's, of course, where the Biden administration failed so completely, as it started rolling back income support programs that it could have fought to keep in place. And the fight would have led it to the mechanisms for money and credit creation and monetary policy. And I think that would have been a fight worth having. Now, there are too many unknowns to make sensible predictions about the coming AI bailout, other than the fact that it will happen. One possible scenario is a massive bailout that is only ever partially rewound, and then a Democratic administration implementing a new round of austerity, kind of to pay for it. But of course, the volatility of the political situation means that there's a chance that monetary policy will come under executive control before too long. And on the other end of the spectrum, there is the possibility of the Mamdani spirit spreading. Now, my sympathies are obviously with the latter, but if that is to be more than like a wave that is followed by another wave of austerity and repression, I think it really needs to learn from the far right and set its sights on control over monetary policy and the mechanisms of liquidity creation. So, and this is to conclude, what kind of analysis can help here? To my mind, the existing drift of much left-wing theorizing, thinking about rentier capitalism, political capitalism, neo-feudalism, is not always super helpful. These theories highlight important features of the present, but they assess those against a misleading benchmark, a less corrupted, less politicized version of capitalism. And to my mind, rentierism and politically constructed property are not like incidental, but foundational characteristics of capitalism. It's a system that has the risk-free return as its cornerstone. It's the core commitment that the operations of the system will maintain. So even stabilization programs that nobody really contests the necessity of only work by reinforcing patterns of artificial scarcity. Then we've seen the rise of a different kind of thinking that sees the concern with characterizing Western capitalism as a basically an essentially parochial pursuit. So it emphasizes that, the democratic capitalism that we enjoyed for a while in the OECD was always premised on a global system of essentially colonial exploitation. How the decline of that arrangement has driven a return to a more predatory, extractivist form of capitalism, and that we're now also feeling in the global north. That story includes the rise of alt finance or private finance, which is a branch of finance that often looks more like, sort of a far-right vigilante militia than the kind of genteel bond traders. And from this angle, thinking about property as an abstract thing is just kind of a Western affectation. It's ideology covering up violence and exploitation. And there's something obviously very correct about this way of thinking, but it also reproduces a problematic tendency, especially on the left, which is that when you run into problems with your own positionality, you want to quickly start decentering and foregrounding other perspectives. And that obviously has some merit, but that's often also a way to avoid examining the heritage you live with. And it's a way to avoid thematizing your own complicity. At the same time, as it closes off the possibility that there might be something yet to recover in that heritage or in that tradition. So financial abstractions are entirely real, and that fact I have argued makes itself felt as the vital role of liquidity in the present, its role as an arbiter of life and death. And in practical terms, that means that we need to get our democratic hands on the mechanisms for liquidity production and distribution. Thank you. I'll leave it there.
Thank you very much. Thank you. Thank you to both of you. This was really quite breathtaking and very nice. And interestingly enough, even though Martin almost emphasized the differences, I had the feeling it was very much a continuation of a conversation, in particular with respect to the storage of wealth as the foundation of liquidity. And when one reads Jonathan's book, one has the feeling he emphasized before capitalism, and that's something that I just shortly want to bring up and then open it up to everyone in this room. But Jonathan's book emphasizes that before capitalism, wealth rather than profit, wealth maintenance rather than profit was the main driving force. And then he takes us through the different ways that we move from return on interest on investment to return on equity and so on. It ever gets shorter, the time span gets ever shorter. And I just wanted to bring up a question, which is maybe the question of Keynes's, uh, well, the investment function in Keynes, thinking about investment in real capital, something that also is in the book by Hicks that we were asked to read. But before you get into that, of course, I would like to give the both of you the possibility to react to each other before we open the floor to everyone. Jonathan, would you like to react for a moment?
Um, my reaction is basically that I have almost complete agreement with everything that Ryan said. How's that for reaction? Maybe raise sort of 2 points. I mean, I think the critique of sector stagnation is correct. I do think, and this might be a separate issue altogether, that maybe the best way to read Keynes on this, if not the kind of subsequent Keynesians, which I think were, it's like the reading of Keynes was horrible. I think it was a plausible reading. I think Keynes, makes this point that we really have to think of like the era of call it industrial capitalism as kind of an anomaly. That the Industrial Revolution truly was an anomaly. Um, and so in a sense, I don't think we necessarily need to call it stagnation. Um, but what Keynes sees is in the 30s returning as to something like the historical norm. And we can think of accounts of capitalism like Brauddel's account of capitalism, in which the rentier interests and rentiers are at the center of the system, and that the Industrial Revolution, therefore, kind of is not the case from which to reason more generally about capitalism. Um, Again, I think that's in line with the notion of a risk-free return as being absolutely at the center of capitalism, which strikes me as correct. I mean, who would want to go through the trouble of employing labor, disciplining labor, finding raw materials, building a factory, you know, competing in final markets to sell a product above cost to make a profit when you can put your feet up on the desk and enjoy a risk-free return? Um, this strikes me as quite right. Um, what it poses the question, though, and I guess this is maybe a question I would ask would be, I mean, it seems to me you have sort of two paths out of a kind of asset austerity dynamic. One is to democratize liquidity in the sense that you would open up the kind of asset price appreciation to a broader constituency. In a way, like that's kind of what happened in the 2000s. It's just in the U.S. residential mortgage market, there was horrible inequities, but I think it was a genuine attempt to democratize. And then, of course, in 2008, we saw what happened, something very different. Or do we need to kind of push? And this is where the investment in real kind of capital assets would come to the fore. Do we need to push investment back into more material goods, back towards labor, back towards production? And if so, what would that look like? Um, and this obviously raises issues of green transition and et cetera. But that would be, I mean, I guess that would be the question I would ask to kind of keep the conversation going.
Martijn, do you want to respond?
Unmute yourself, please.
Sorry, thanks. Um, there's a few things. Like Jonathan, I didn't feel there was anything that I really disagreed with. And he said, I haven't read the Hicks book that he spoke about. So at various points, I was not sure that I wasn't sure that I was entirely getting what he was, the argument that he was making, or if I was understanding it correctly. But I do think that like a lot of the comments that I made about sort of the relationship between capital and liquidity resonate with Jonathan's latest book, The Real Economy, where sort of the idea of capitalized property starting to function as a what does he call it, like a virtual attractor, as it were, something sort of reshapes the economy as a whole. And to my mind, that is what instates, creates the liquidity problematic. Once you have that logic, once you have commitments that are locked in, you will often find yourself in a scramble for means of payment. And that's contrast quite starkly, I think, with earlier social formations. Although I also do appreciate the need to know more about those, and that I'm hardly an authority of any of this. And some other people, I think somebody like I forget his name, Colin Dunn, I think. He's very strongly made the argument, actually, in a review of a book of mine, that liquidity problems were just as intense for the average medieval farmer as they seem to us today. So I think there's a lot to. So I'm not sure about that, but there's a lot to unpack there, I think. I was also very intrigued, actually, by this notion of land having once functioned as the main sort of liquidity. Yes, we now occupy a mental sort of environment where that is so hard to imagine. But yeah, like when you put it like that, it makes perfect sense. I think that would be really something really useful to unpack. And then in terms of the question, are we going to democratize liquidity or push investment into production? Well, I would say the first, and that might also include some of the second, I suppose. So democratizing liquidity has to be modeled, has to be a far more radical experiment than it was in the early 2000s. It really has to be about finance and liquidity production becoming subject to democratic protocols and collective decision making. And I would like to think that those kinds of processes will make decisions about, what to save, what to spend, and what part of it should be public, which part of it should be private, and what kinds of production will be worthwhile to invest in. And obviously, the green transition here, looms fairly large. One hopes that those kinds of processes would, steer that process in the right direction as well.
Okay, thank you very much. So, in a sense, one could almost say that you're embracing the idea of socializing the investment function. I mean, I just want to tease a bit and bring back a little bit the Keynes of the general theory here, and maybe also for a moment speak about a triptych if that's the right word, in the chapter that Jonathan has sent around on primal capital, where if I read you correctly, you're basically saying the fetish of liquidity, a word that both of you also don't want, or I would like you to invite you maybe to think about if you want to use it or not. But the fetish of liquidity leads to an obsessional neurosis that leads to nobody ever taking a real decision. That's if I read Jonathan correctly in that chapter, it basically says, as you put it now, you have a free, you have a free risk-free rate, so you just keep going with whatever you're doing. But where does that leave us with respect to while taking some decisions that bind us in a path forward? So this is kind of what Perry Merling and others have pushed in their books, this idea of balance sheets being a means of forging a path into the future, right? And you have written about this, Martin, of course. So just where does that leave us in a capitalism where you get this risk-free rate guaranteed? I mean, or am I making up a distinction or dichotomy that doesn't really exist? What would you say to that, maybe? And then we
Well,
have.
sure. So yeah, I think the I think in a capitalist system where capital is privately owned, that fetish of liquidity arises, and I think it's actually perfectly appropriate to describe that in sort of Freudian terms of the neuroses of hoarding and being so obsessed with securing yourself for the future that you're completely paralyzed when it comes to making decisions about how you would shape that future. Um, I think the objective, I realize that no, political or economic institutional rearrangement is going to transform the sociopathology of capitalist life overnight. But the point of socializing the investment function is to push back against those tendencies to empower sort of collective processes in a way that invites people to make use of it rather than see their fortunes bound up with dependent on their private ability to hoard. Yeah, let me just leave it at that.
Thank you. Jonathan?
Maybe I mean a few things. One, I think when Keynes, I mean, I offer this sort of reading of it, which might be right, might be wrong. But what things I am certain of, I mean, when Keynes talked about the fetish of liquidity, I think what he meant in that specific passage is that thinking in macro terms, like the economy can't be more or less liquid, right? I mean, the economy is a level of output, a level of employment, and a level of production. And so the fetish of liquidity is that people thinking that they're that they're attached to liquidity, getting liquidity, exercising liquidity preference. In a macro sense, it's just a fetish, right? It doesn't do anything. In fact, if you have speculative or precautionary liquidity preference, that undermines what he would call productive investment. The total economy suffers from a lack, right? So it's another way of a kind of macro micro kind of paradox that sort of runs throughout Keynes. That's kind of one thing. I mean, second, it strikes me. I mean, I'm just sort of posing this as questions. I mean, I think at some level, just intuitively, it strikes me that democratizing liquidity is a good thing. That must be part of the kind of politics that we need for the economy today. But it also strikes me that it's very different to say direct cash transfers to households, which I would support, giving people money outside the labor market, is a good thing, versus then saying, well, the liquidity bind occurs when there's a committed investment such that one faces a means of payment bind while they await for that investment to realize. Um, and socializing investment, we tend to think, right, of that as, well, we need public investment, more public investment boards, public investment authorities. I would endorse that too. Um, But if we come back, which I think is an intriguing line to kind of head down that Martin brought up of, well, like what would it mean to democratize the ability to take a risk, make a long-term investment, such that one wouldn't face a means of payment bind while awaiting that investment's realization. What would that mean? What would that look like? I mean, I think that's actually an interesting question. And now we're talking about not redistribution ex post or ex ante. We're talking about like literally how to transform like actual business enterprise, like the actual conduct of business, which strikes me as would have to be part of a democratization of liquidity.
So reminds me of many things like Eric Monet's book and the debate about it. But before we go there, Katharina had her hand up.
So first, thank you so much for both presentations. It's been really fascinating. I have tons of questions, but let me maybe ask my one or two questions about history, using thinking about the history of liquidity, which I think is fascinating, and then maybe bring it into the present and think about the democratization of liquidity. So with regards to history, I'm sort of struggling a little bit with the land as a store. Of course, land, of course, as a store of value. The liquidity issue, of course, is complicated in feudalism when land is not alienable, and so the only thing that we can do is then mortgage. But that also raises interesting questions about the allocation of liquidity risk between the landowner and the creditor. And I think in England in particular, that equation was solved in favor of the landowner versus the creditor. And that was changed only in the late 19th century. So I think sort of it would be interesting also historically to think about sort of what, depending on what kind of the asset is that is the reserve asset, but also how the political system or the legal system that I would stress allocates sort of these liquidity risks. And on the industrialization, I think in some ways I can see that it's an exception. At the same time, everything that both of you have foregrounded, the invention of an abstract concept of property, and of course, sort of the issuance of more financial types of assets coincides with the rise of industrialization. So I'm just wondering whether we can just dig a little bit deeper on that. Then bringing it to the present, I was thinking about when we think about the democratization of liquidity, which I also fully endorse, and of course the devil always lies in the details, is whether the essential hybridity of private money creation and public money creation that Merling has pointed out, and I think somewhat, of course, Minsky also endorses, that this would have to be overcome because you can't have a system where with private money creation and I think a democratic investment strategy. I think we have to think about money creation for particular investments, and maybe the the allocation in the end can be left again to private. But I just find it hard to think about a system in which we continue to have private money creation combined with the socialization of investment decisions. Well, thank you.
You choose who wants to start.
Maybe
Okay,
I'll
sure.
start
I'll
with
go.
Martin, go ahead. No, let's go reverse order. You can start the president, and then we'll trace it backwards. By me.
Okay, cool. Okay, so let me just start with essential hybridity, which is, like I completely agree that there's that sort of is core to understanding how it is that we have stable financial systems. They're not always stable, but to the extent that they're stable, that is because of essential hybridity, the private and the public functions interlocking, and governments protecting the liabilities of large of the key debt issuers. So yes, that would have to be overcome and I mean, I guess this is sort of just the Hegelian Marxist in me sort of coming out, but this would have to be overcome. It would have to be a fairly, decisive shift towards the public taking charge of those private mechanisms for liquidity production. Now, at that point, you can sort of get like caught in a whole sort of debate of like, well, how much is market socialism is possible? Can we have little pockets of? And like I'm sure that is interesting in its own right, but I think the main point is really that we already understand this at a certain level when it comes to the treasury, right? Like right now, we're not so sure anymore, but in principle, that's the people's money. That there's no huge amount of confusion about that. Now, with the Federal Reserve, it's a bit of a different story because, whose money is that? The people's money? Nobody really knows. It's supposed to be independent, but we know it's sort of in cahoots with the banks. So it is really, to my mind, about democratic processes getting their hands on that configuration. How is liquidity produced? Where it's produced in ways that isn't in the general interest? What can we do about it? And how can we dismantle or reconfigure or repurpose this sprawling structure of subsidies and protections and bailouts and backstops for sort of this too big to fill constituency in Wall Street. So yeah, there's a definite. It's not a policy program as such. It's a political program that I think has an important policy dimension because there are many political programs that are not interested in doing that.
Thank you, Jonathan.
So I think I think one that if money is the same as liquidity, then we don't need the concept of liquidity. We can just talk about money, right? And so the question becomes, well, is there any remainder? Is there anything left over that we can't explain by just appeal to money that liquidity points to? And if so, what is that? And I think, and here Hicks was right, and I think Keynes was onto this, but was confused, is that liquidity refers to how the present connects to the future. Keynes said of money, it's an odd thing to say about money when you think about it. Money is, it always says in the economy in which we live, so it's specified, is a subtle device that connects the present, to the future. And so to say that land in a pre-capitalist economy, feudal economy, was the principal institution through which liquidity realized itself, is to say that the reproduction of economic life over time was mostly rooted in land and the ownership of land. It's where people lived. It's where people worked. It's where biological reproduction occurred. And not the least, it was a form of property. And then there is a history, which is the rise of capitalism, both in an agricultural context and a financial and ultimately an industrial context, through which that liquidity becomes part of, I think Martin put this very well, it becomes part of a kind of abstract virtual system of property relations that have been monetized. And of course, credit is really important to that. And so I guess, like, what would be I don't really know, but it strikes me that the implication of that thought would be, when we're thinking about liquidity in the present context, we really want to be thinking about how the present tense connects to the future tense. I'm not sure that that the public-private issue is a extremely important issue. I'm not sure there's much at stake kind of there, but it does strike me that one thought this leads to, which is the thought that Keynes played with at the end of the general theory, that many other people have played with too, is thinking in terms of multiple monies. So it's odd. It's a product of capitalism. It's also a product of the rise of the modern nation state, that we've smashed all these monetary functions into single currencies. Today, we've smashed it into a global currency, which is the US dollar. That means the payment function, the standard of value function, the store of value function. And I think, like, it wouldn't be that hard to think of part of the democratization of liquidity as being to fracture those functions into different monies, which would be subject to different forms of private and public, control. So look, I mean, do we need to connect the present to the future? Absolutely. There's the life cycle, there's demography, there's all kinds of reasons why people need to save and accumulate wealth in a economy that's completely legitimate from a democratic, normative democratic point of view. But in terms of the financial plumbing, it strikes me that talking about public or private money can kind of obscure the different forms of money that could exist. I mean, Keynes, to make this more simple, Keynes talked about time stamping different kinds of monies, right, to sort of prevent people from accumulating over time wealth in particular assets, monetized assets. Maybe we talked about production and investment, a kind of if you don't use it, you lose it type of money, right? That you could own, but then you have to be willing to take a risk and face a means of payment constraint, et cetera, et cetera. But I think that's the kind of thought, those are the kinds of thoughts that thinking of liquidity from the reserve asset perspective would lead to.
Yeah, great. I've noticed that some of you have turned on your camera, Anush. So if you want to ask a question, I'm happy to bring India in. We have
I have things to say other than India, but I'm happy to come in.
of course, no. I mean, I just wanted to say the time zone. Sorry.
Sure. I'm actually in DC right now, but shall I go ahead?
Yeah, please. And then Robert.
So I just wanted to come in. Thanks for those lovely interventions, and it's nice to see people again. I just wanted to come in on this point about the democratization of the money function, liquidity function, investment function, vis-a-vis essential hybridity. And I've had this kind of conversation with Perry for a while. I've always thought that the essential bit of the hybridity is not public-private. That is a almost parochial expression of a deeper hybridity between the kind of core arteries of the system and the capillaries of the system. Any credit system has to be simultaneously concentrated and distributed in order to connect the present and the future, to connect a complex division of labor, and so on and so forth. That sort of core capillary distinction is in Western credit systems mapped onto a public and private distinction. Public, you've nationalized money, but you've kept banking private. This is one way to express this. So what's essential is the hybridity between core and capillary, not the expression of that hybridity as public and private. In other words, one can have a system that's entirely public and hybrid in the first sense, but not hybrid in the second sense, right? So you can have public balance sheets at the capillary level and public balance sheets at the core level. This is a nationalized banking system, right? That preserves. So that's a way to kind of, if you like, get over the public-private distinction while preserving that core essential element. Now, again, the devil is always in the details, and politics will obviously dictate how will sort of play out in different ways and will express itself in different institutional configurations. But I think that's important to think through. That it's hard for me to imagine a system that is not simultaneously concentrated and distributed. But it's not hard for me to imagine a system that's entirely public because, of course, both India and China, in their various degrees, have entirely public systems that are not that are hybrid in the first sense, but not hybrid in the second sense. So I just wanted to put that on the table. That the essential part of the hybridity, it's reading money from a very from a kind of parochial standpoint to cash that hybridity out as a public-private distinction. That's very important, and of course, the hegemonic countries are organized like that. So we need to pay attention to that. But I think when we're thinking about how to democratize the thing, there are other distinctions or there's this deeper distinction that I think we need to kind of attend to.
Thank you very much. Great. Now, Robert, and then maybe Anna, but she can decide for herself, of course. Robert? You have to unmute yourself, please. Robert Meister, could you unmute yourself? Can we unmute
Yes.
him? Not work.
Yeah, I was intrigued in both of your articles by the question of the relationship between democratizing liquidity and inflation, and particularly in the question of Minsky's treatment of inflation, which is fundamental to stagflation, particularly fundamental to the political climate in which he wrote. One of the things that happened when liquidity provision was created to support or backstop, de-risk the downside of capital markets is that capital markets rose, and they rose in a way that was largely unidirectional. And a unidirectional movement in asset prices supported by liquidity provision is called accumulation. Now, when prices in the underlying market, the market in goods and services, rise, a unidirectional rise in prices is called inflation. And you can say that this is democratization, but it actually produces a democratic reaction against liquidity provision when it is inflationary. So I'm wondering whether it isn't partly an historical and partly an epistemic problem that that liquidity provision to support asset markets does support asset markets, and a codirectional rise in prices is addressed by the concept of beta. That is to say, it's not called inflation, it's simply called beta. Whereas in the case of commodity markets, we don't think, even democratically, that rising price levels that are created by liquidity support are going to be democratically popular. Isn't this a political problem? Isn't it an historical problem that we don't think this is simply a matter of inverting a price quantity fraction, so that the more something costs, the less a dollar is worth in both cases? Don't we need to talk about class and the difference between commodity markets and asset markets here?
Great. Should we take the second intervention and then Martin and Jonathan, you can get back to it, or would you like to answer now, right now? Let's have one more. Anna, please. Great intervention. Thank you, Robert. Really.
So following up in particular on Anusha's point and several other kind of interventions that came up, thank you for two very stimulating presentations. I'm trying to figure out the scale at which we are operating when it comes to democratization in particular. And I think it's particularly complicated when we're kind of merging historical analysis and, somewhat sort of atemporal theoretical framing, right? So are we talking about democratization at the scale of existing political units, right? Local, regional, global, pick one. Or pick multiple, are we talking about democratization at the scale of existing infrastructure, maybe financial infrastructure? There's another possibility, which is markets for goods and services. And in a way, what Anush made me think is that you're talking about multiple democratizations potentially happening in overlapping spaces. So help me think through how your thesis works and the scale at which we should be thinking about it. Thank you.
Well, you have your plate full. Please, Jonathan, Martin, sure. Thank you.
Okay, thanks. Okay, so let me take the last question first, which I think is a really important one. Yeah, so the way we were just talking about it, like it was a completely abstract concept, no skill, no geography to it, no national units attached. Completely get that. The way I see it is that anywhere is a good place to start, and that you have to be prepared because of the conflict of interest. It will very quickly engender. To be, you have to be prepared to be to deal with the tensions that it will generate. So you can see this right now, like, one of the reasons for Mamdani making nice with Trump is, of course, that his project will ultimately need to not be sabotaged by the, well, municipal bond market, but also other financial institutions that could make life very hard for him. Now, sort of making nice with Trump is not really a reliable strategy. So at some point, there has to be, something else has to take the place of that, or it has to be built on that. But to my mind, the lesson here is really that democratizing credit is not something you do, and democratizing finance is not something you do and then you're done. It's just, it leads you to the places where the battles will take place. And I think actually that Minsky understood this quite well. So for Minsky, Minsky believed in a job guarantee, but I think over time you could sort of see him shift his rationale for doing that. Like I think in the 60s, that was just like a sort of an industrial policy intervention when he was in California. Over time, I think for him, it just he realized that demanding full employment, true full employment, was a way to push against the limits of what the system could accommodate. It was a way to kind of open up, to expose the limits of the system and to politicize them. So and same thing with respect to a sort of relation to things like MMT, right? Like for Minsky, all of these things were not primarily sort of neat policy solution that you could adopt to avoid the politics. These were things you could try to get you to where the battles needed to be fought. And I think that is an important difference. So, like it's completely impossible to set out in advance what kinds of skills you would need to coordinate, what kind of alliances you need. But you can strategize around, what are the points, the real sort of points of contacts that matter. And that would be an improvement insofar as, like, you often do feel in mainstream politics wastes a lot of its firepower on fighting for things that don't lead them anywhere. It's just a victory that demobilizes rather than mobilizes. So that's kind of how I would see it. Then some of the other, so Robert's comments. Basically, I think I want to say I completely agree that we do need to pay attention to both commodity and asset markets. And I think insofar as that suggested a connection to Jonathan's comments about, like, well, we need to think about, different measures. Lots of non-commensurability. I think that is very useful as well. I think Dick Bryan just recently wrote a book on how you can sort of use sort of derivative logics to prevent this sort of constant drive towards integration into systems of commensurability. So yeah, I'm on board with all that. That's as much of a thought as I have about it right now.
Thank you. Thank you. Jonathan?
Maybe just quickly on the scale question. I mean, I agree. I think it's all the above, and start anywhere you like. I mean, it strikes me that the issues we're discussing, the global scale is extraordinarily important. You're dealing with the dollar as a global currency of reserve and transaction. Like you'd have to do something about that. Good luck. Um, the national scale. I mean, I do think the kind of multiple currency framework can help for thinking across geographical scales. I mean, certainly if we're thinking about the political economy of liquidity provision, if we thought of it in terms of the geography of liquidity provision, it would be a quite narrow geography. So it seems to me most of the ideas about kind of socializing investment, public investment, democratizing investment have important kind of geographical components in terms of thinking of region and also at the level of the local. So those are some just kind of somewhat stray thoughts about that question. Bob's question on commodities and inflation is good. Um, I, this gets back to one of Martin's remarks, which I thought was very provocative about, do we start with the commodity at sort of first level, first principles? Of course, Bob's written a lot about this, thinking of assets as opposed to commodities. And I think that I'll come back to Hicks. I'll keep plugging Hicks. One of his points is maybe they're not all that different. Commodity markets involve stockholding, much like asset markets and finance involve reserve assets. And one of the points that Hicks makes is that stockholding is really effective for accumulating surpluses, but stockholding is not good for dealing with shortages because people will hold stocks back from the market for a speculative motivation to hope to create artificial scarcity on top of real scarcity uh, in hopes that prices rise. So I'm not sure the dynamics with commodity markets or asset markets. I think they have differences, but they might have more similarities. And I think disaggregating inflation to thinking about inflation, across different sectors of the economy in that respect can be helpful to see inflation happening in different places and at different times. But that's just like one thought, Bob. But I mean, I think that you're quite right to um, to raise the issue.
Okay. Can you hear me? Does this work? Yes. Sorry. So this is just wanted to come in at the end, maybe, or we have still 10 minutes. It's for me to say or to hold up a thinker that we had last time, Luca Fantacci, who has written this beautiful book about the end of finance, and to evoke his idea to say that I think democratizing liquidity is not necessarily and straightforwardly such a great idea, and for sake of argument, and rather to evoke those moments where we go along towards maybe definancialization and for example, for the realm of housing, um, but also, and I like very much the idea, Jonathan, that you brought up about Silvio Gesel's idea of timestamping money.
Mm.
But that is almost like a certain refusal of liquidity, or making it into this clarity of like this is your capital to invest in taking risks and it will go away, rather than having this idea of well, if you run into trouble, somebody will come and bail you out. For me, these are two not necessarily the same thing. And I don't mean to give the short shrift to the poor and bail out the rich. That's not what I'm saying. But is democratizing liquidity really such a great value added? Yeah, sorry, but we have Dario now, and then you can maybe have another round of responses.
Mhm.
There is one thing that puzzles me about democratizing liquidity from the very beginning in the language. When we talk about democratizing liquidity, what do we mean? Do we mean that QE has to be decided by a politically appointed person that has been democratically elected? So are we saying that Trump or his acolytes that have been democratically elected in the political process have a say in how liquidity should be distributed through the central bank? Or are we talking about something else? Because it seems like this type of meaning has been shifted a lot during the conversation, and I think it's important to be precise about this. And the second aspect that I have in mind is what do we mean when we talk about liquidity in the democratization of liquidity? Because one thing is pumping money into the system to prevent a liquidity crisis, a liquidity spiral in the financial system. Another one is fixed capital, which is the opposite of liquidity, is as illiquid as it gets when we're talking about social function of investments. So I think that in order to bring forward this type of discussion about where we land, where we're going, before even we start to unpack whether it's private or it's public, I think we should really clarify what do we mean by democratization here, democratization of what, and what do we mean by democratization, and what type of liquidity we have in mind.
Okay, thank you. So, floor is yours. I don't know who wants to go first, but so,
Well, I'm a huge fan of Fantachi too. So I think End of Finance is an extremely important book. Um, I guess but when I think about that is sort of two things. I mean, one is sometimes I'm concerned when um well the sort of definancialization narrative in the sense of um we really just want money to be a means of exchange. That's what money should be. Um, and so getting rid of the kind of liquidity function is just to return to almost a kind of pure free market state where money just serves one function and that'll get us closer to market equilibrium. And the second thought I think sort of ties to that. I mean, to some degree, the genie's out of the bottle. So um, over the last century, we've developed an extraordinarily sophisticated set of political and economic and legal tools um, to provide liquidity. And I'm not sure it's viable from just a political perspective, but just we're going to put the genie back in the bottle and return to a kind of pure form of market capitalism in which we're all taking risks again and failing when we don't succeed. So that would be my response to that. The clarification on democratization of liquidity is important. I mean, Martin would have better thoughts here than I would. I mean, I think one way in which it's come up has certainly been just access, right? Who has access to liquidity? Who can stay solvent and not go insolvent in situations when liquidity seems to be drying up? And I think most of us probably have in mind somewhere in the back of our heads how 2008, what happened, and a sense of who gets bailed out and who doesn't. But you're right, that's only one, very specific kind of meaning of that term. And there's other ways in which we could think about liquidity with respect to democracy. And Dario, you mentioned a very important one, which is a kind of democracy that likes illiquidity. And I've written about historically political illiquidity preference, and have kind of described the mid 20th century in the context of wars and also social democracy and the New Deal as a kind of political exercise of illiquidity preference. And so, in that respect, the politics of a democratic politics of illiquidity, I think you're right, in certain contexts could be just as important as a democratic politics of liquidity.
So, okay, so first, the issue of sort of definancialization. Oh, sorry, here go tapping. Definancialization. Yeah, I think I'm on board with Jonathan's comments there. I think it's just too much kind of steeped in this fantasy that we can go back to something And I think that thing that we want to go back to was always a fantasy. So perhaps the village fair, the way Minsky portrays it, never really existed. There was never a place where
Well,
liquidity.
that's not at all what I meant. I just want to abuse my privilege here to say that's not at all what I had in mind. So sorry.
Oh, okay.
I can clarify a bit if you want, because I just wanted to say that you can provide social housing, you know,
Okay.
that's a way of definancializing the world.
Okay, cool. So that's definitely, oh yeah, you did say that actually, sorry. So yes, I think that would be great. My sense is still that the horses bolted a little bit, that it would be hard to, at this point, return to forms of sort of in-kind provision that that don't become subject to the kind of pressures that emerge from financial strategies that people have learned how to execute. But I would totally give this a run for its money, and if it's on the ballot somewhere, I'll vote for it. So like it's, but I don't. I'm not putting too many of my eggs in that basket in a way. Then the other thing is very important though. Like, so what do we mean by QE? Is democratizing QE what's happening now with Trump getting his fingers, all over the Federal Reserve? Like, no. I would actually say that the fact he can do that is that we don't have sort of a countervailing power there, and an already existing project to democratize the Federal Reserve and its quantitative easing programs. So, like, and one thing I did think was very interesting during the pandemic was how easy it was for the Fed to start giving credit support to any number of firms who needed it. I remember kind of going through the list, and there were all these firms, like there were all these firms that you'd never heard of. Like one of them was like Smuckers, like they make these like peanut butter jelly sandwiches that are delicious but terrible. And they got like, I think, they bought some of their commitments. And so I went through the list. I was like, wow, if you can do this at a moment's notice for all these companies, then you can do it for childcare centers. You can do it for schools. You can do it for community sports associations, whatever, right? Like there's an endless list you can think of. And I think that is the goal. But again, like I don't imagine this can be done without a fight. Like this is clearly, first we need to know where the fight is, and then we can sort of set our sights on it. And perhaps the last thing that came up in that conversation was that, yes, I think that, making illiquid investments can entirely be part of that, and should, in many cases, should be. So it's not about just sort of maintaining liquidity. It's just who is in charge of the liquidity that we have. And that should be the people and their, representatives, but different representatives than we currently have.
Okay, thank you very much. It is 10:32 p.m. in Europe, 4:32 p.m. in the US, and I think 10:32 a.m. in Australia. Is that correct?
8:32 p.m. in
Oh my
Australia.
goodness. Thank you very much. This is 8:32 in Australia. So thank you everyone for being with us. This was really, I think, an absolute highlight in terms of social theory and thinking about the strategies for democratizing finance or politicizing finance. So I want to thank all of you for being with us. I want to thank the two speakers for really being provocative and a very, very high level. And I hope we can keep up with that in the future. You really set a very high bar. So thank you very much for that. And I hope you have a great morning, evening, afternoon, whatever. Okay. Have a great day. Thank you
Thanks,
very much.
Matthias. Thanks for having
All
me.
right. Thank you all. Thank you.
Thank you.
Thanks for
All
organizing.
right. Bye bye.